Welcome to Excess Returns, where we focus on what works over the long term in the markets. Join us as we talk about the strategies and tactics that can help you become a better long-term investor.
Justin Carbonneau and Jack Forehand are principals at Validea Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validea Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validea Capital.
Hey guys, this is Justin. In this episode of Excess Returns, Jack and I take a shot at breaking down the current bear market. From ultra-low interest rates, quantitative easing, lofty valuations, the drivers of inflation, and now higher interest rates and much more. We talk about how we got here, where we are today, and where we may go from here, and the perspective long-term investors should take when trying to make it through difficult market environments like this. We have some charts and visuals in this one, so you might want to watch it on YouTube. You can use the market valuation tool that we reference in the podcast that we run on Validea by going to www.validea.com/market-valuation. As always, thank you for listening. Please enjoy this discussion. All right, Jack, today you and I are going to spend some time talking about the current market environment we're in. We're actually in bear market territory now this year. How we got here, where we stand today, and where we might go in the future. I mean, these are important things, I think, for long-term investors to sort of understand and consider. And hopefully, as we work through this, we can help people understand the things that are happening in the market, and then give people some pieces of information or wisdom that can help them make it through to sort of maybe the other side of this when we come out of it. So to start, let's just talk about maybe how we got here, sort of what led up to this over the last few years, how we got here. And I think a big part of it starts with the Federal Reserve. So maybe I'll let you talk to some of that, and then I'll add on.
Yeah, traditionally, the main policy tool of the Federal Reserve has been the idea of, moving interest rates up and down. And what you saw in the wake of 2008 is you saw the use of an additional tool, which is this idea of quantitative easing, or the Federal Reserve buying bonds, as another stimulative policy. And so it's just important to kind of keep that in mind as we work through this, because that tool was used in the wake of 2008. It was used a lot in the wake of 2020, and sort of it helped, the use of that tool sort of sets the stage for where we are. And, one of the big things to keep in mind with that tool is a lot of people, when the Fed started doing that, said, well, that's going to be inflationary. It's going to drive up prices in the economy. And, a lot of even well-known economists said that. And, people we follow like Cullen Roche said, well, that's not going to happen. And they ended up being right. And, I think the key thing to keep in mind with quantitative easing is essentially just an asset swap. So, a bank that has a bond on its balance sheet is getting that replaced by cash. And so that money really never makes its way into the real economy. And so that money never gets in people's hands and gets used to buy goods. But what that money typically has done is it's driven up asset prices. So that money has ended up in places like the stock market. Liquidity has been added to the system. The stock market has gone up. And so just as we set the stage, with the Fed, I think it's important to keep that in mind, that probably has been a significant driver of the market going into this period. And now we'll talk later about how that's reversing, but that's just setting that stage and thinking about the use of that tool is important as we head into this.
But that is one of the things, during the financial crisis, the Federal Reserve and the government had to come in big time. The Fed had to lower rates and keep rates low for a significant amount of time. And every time they tried to move, I think it was it was a couple of years ago that the Fed started to raise rates, and the market really reacted negatively.
End of 18.
Yeah, it was the taper tantrum, I guess. The Fed was really trying to move rates so that they had a tool to lower rates should we go into a recession in the future, whereas now it's more, and we'll talk about this in a little bit, it's more being driven by higher levels of inflation. But that is one thing that I think when you look at the level of interest rates over the last 10 years, they're far, far below the historical average interest rates that we've had in this country going back to, 100 years or so.
Yeah, the other thing we should say about the Fed before we move on to the next thing is this idea of the Fed put, because that's something that's been in place for a long time now. And that's essentially the idea that if the stock market goes down enough, the Fed's going to pivot, and they're following, although they're supposed to be looking at, unemployment and inflation, there's this third thing they've been looking at, which is what the stock market's been doing. And what you saw in the end of 18 is you saw that Fed put kick in. So we had something like a 20% decline, the Fed reversed, and the market went back up. And so historically speaking, at least since 2008, that Fed put has worked very well. When you see those declines, the Fed is reversed and you end up with the market going back up. And we'll talk later about why that might not be there anymore, but it's just important to keep in mind that has been something that's been in place, not officially in place, but unofficially in place, in that period.
So the other big thing that happened during COVID was the massive injection of the fiscal stimulus that the government came in with. So, consumers got money directly put in their hands or their bank accounts. You had PPE with the payroll protection, and, you had trillions of dollars basically of fiscal stimulus. And that was very different than anything we'd seen, since the financial crisis. And even during the financial crisis, you didn't see that level of, direct money directly into consumers or companies' bank accounts. And so that's another factor, I think, that sort of plays into sort of how we got here.
Right. And as you said, that is a game changer. So when we talked about how monetary stimulus doesn't end up in people's pockets, so it doesn't end up being inflationary. Well, what the government did in the wake of 2020 is they put money in people's pockets. And when you do that, they are going to spend that money. And, particularly as you work towards maybe the bottom end of the income range, people who have lower incomes, when you give them money, they have a much higher propensity to spend that money. If you give Elon Musk $1, it doesn't matter. If you give somebody towards the lower end of the income, range $1, they're going to spend the money. And so what happens is that type of stuff becomes inflationary. And, what happened before, as we sort of headed into this year is, we started off with some stimulus after 2020. We did some more. And, one of the challenges with this stuff is the effects of this is lagging. And so from the perspective of policymakers, what they were seeing is we were giving people this money. People were really happy to receive this money. We're not seeing any negative effects of this. We took something that would have been a major crisis in 2020. We made it a lot better by putting money in people's hands, and we're not seeing any negative effects. And, one of the things, and this is not a political thing because it's both sides of the aisle, one of the things that politicians will do is if they're doing something and there's positives associated with it in the short term and there's maybe unknown negatives in the long term, they're going to keep doing it. And that's basically what happened. And that's, as we'll get to where we are today in a little bit, but that's essentially what happened is they kept piling fiscal package on top of fiscal package on top of fiscal package, which was an inflationary thing.
Now, I don't know if anyone has any hard data on this, but, there was this narrative going on in the market that, a lot of young investors at least were taking their stimmy checks and, putting it in places like Robinhood and investing. And that was, partly driving up the prices of stocks. I haven't seen any statistics on that. I'm sure some people did. How much of it made its way to the overall stock market, I mean, we may never know. I don't think that's something you can track. But the one thing we do know is coming into this year, stocks were really, really expensive. And this is a chart we'll put in the presentation. Actually, if you're listening to this on Apple and you also follow us on YouTube, you might want to pop over there because we are going to put some charts in here. But the I think coming into this year, the Shiller PE, the CAPE ratio was something like 37 or maybe even close to 40. It was the second highest Shiller PE historically, going all the way back, to whatever, the late 1800s. The highest peak was during the dot-com boom and bust. And that's come down given the decline. But I mean, that was one of the things coming into this year. We had very, very lofty valuations in the market.
Yeah, and also just to pick up on your point about fiscal stimulus, another way, like you said, it's hard to know how much of that money ended up directly in the stock market, but a lot of it indirectly did. And the reason is because when people spend money, the profits of corporations go up. And so we had a significant profit boom in the wake of 2020. And so that ends up, benefiting public companies. So, whether it went directly into them or indirectly, that also was likely something that was driving up the stock market. But to your point about valuations, yeah, no matter how you look at valuations, coming into this period, they were very high. So coming into the beginning of 2022, they were very high. I mean, they were not .com levels, but 37, if you sort of look at this long-term chart of the CAPE, 37 is the second highest value ever, next to 45 in the .com. So we did have high valuations. And, one of the things we like to look at on our site is we have this chart of median valuations. And median valuations is essentially you just take the valuation of every stock, you sort them in order, and you pick the middle one. And so that tells you nothing about the valuation of market cap weighted indexes, but it does give you sort of a general idea of how expensive is the average stock. And coming into this year, that also, we've had that chart on our site since the end of 2005. And that also was the highest it's ever been in that period. So the idea on valuations, and we'll talk about what's happened to them since then a little later, but valuations were ultra high coming into this year. And I think that's the most important point to keep in mind.
Yeah, one of the things that sort of scared me is when I would see those charts of how many stocks that were trading above maybe 10 or 20 times sales. And I think we may have hit a peak in terms of the number of stocks trading at 20. We're not talking earnings now, we're talking 20 times sales, which I think earlier in the year we may have had the most number of stocks actually trading at those types of valuation multiples. But those are the stocks that actually have gotten hit the most in this downturn. It was the high growth names, the names that were in some of the funds like ARK and stuff like that. A lot of those stocks have actually been decimated here as this sell-off has sort of materialized.
Yeah, and to your point, and we'll put this chart in there as well, if you looked coming into this year at growth versus value, growth was basically as expensive as it's ever been. There was, the spread between those two. So we kind of look at growth as the top 20% of our database, and value is the bottom 20%. The spread between those two was at an all-time high. So, for a long-term value investor, you might have seen a pretty good opportunity there in those spreads. But having said that, those spreads have been wide for a really long time. And so, they're not a great timing tool. And so as much as they looked extreme, they looked extreme for a very long period of time before anything happened about that.
One of the things that we've been trying to do, and you've actually done a really good job at this, is trying to understand market structure a little bit better and some of the sources and influences of stock market volatility. And it kind of comes out of the the GameStop, like meme stock type of events that occurred and what drove that, but also sort of just looking at things like the impact of options and option dealers, and the impact of passive investment flows. We had Mike Green on the podcast, and his idea is that the passive flows are going to become more and more important and influential in the market as more of the market goes passive. So these are just things, and I'll let you talk to these, but these are just things that we've been trying to wrap our arms around as sort of we've learned and grown as investors and trying to understand the impact of these things on the markets.
Yeah, these aren't necessarily something that are a huge issue for someone with an ultra long-term time horizon, but all of us are looking at the market, on a fairly regular basis, and we're seeing this increased volatility in the market. And so one of the things we wanted to do with the podcast, and it's better to go to those episodes because we can't explain all this in complete detail here, but we've been trying to look at some things of why that volatility is higher. And one of the reasons is this whole idea of option dealers. And basically the difference with options versus stocks is, typically if someone's buying and selling Apple, you have people on the opposite side of that trade who have inverse opinions. One person's positive and one person has some reason to be negative. But with options dealers, when you buy an option, the person taking the other side of that trade does not have the opposite opinion of you, and they don't want to have any position in the outcome there. They want to be hedged against it. And so what happens is when people are buying options, these option dealers are buying and selling the stock behind the scenes in order to make sure that they don't have a position, to make sure they're hedged. And what happens is, those types of flows can really impact the market. They can be at certain times, like this year, they can add to volatility, and at other times they can reduce volatility. And I would recommend the episode we did with Brent Kachuba to learn more about this, but just the general idea is that is a source of either reducing volatility or adding to volatility, but it's playing a big role in what's happening in the market on a day-to-day basis. So it's important to understand. And then, like you mentioned, the episode of Mike Green is also really good because one of the things Mike has shown is that passive investing is rising a lot. And as passive investing has risen, there's a couple of side effects of that. One is you get this sort of slow drift up in the market. When someone adds money to their 401k, it doesn't matter what the valuations of those stocks are in the passive vehicles. That money will just be invested. It'll be invested in market cap weighted indexes. That tends to have more of a positive impact on the biggest stocks. But then also what that can do is it can increase volatility. And so in certain periods, there are less active investors out there. And so when passive might flip the other way, you can have a significant period, where volatility goes up. And so Mike kind of talks about it with some extreme levels. Like this could really drive up the market to really, really high valuations, but it could also cause some significant meltdowns. So I'd recommend people go to his episode to learn more about it. But the general idea is there's these things out there, whether it be option dealers, whether it be the rise of passive, there's these other things out there that are more flows based that are having an impact on the market on a day-to-day basis. Yeah.
So in about 15 minutes, we are sort of trying to sum up how we got to where we are today. And where we are today is we are in a period, at least from an inflation standpoint, where there's two different, drivers or catalysts that are driving inflation here. One is, and we talked about earlier, that amount of fiscal stimulus that came in. So you have this demand-driven pressure on the market. So there's too much money, chasing. Well, we'll talk about the too few goods part, but there's consumers have a lot of excess money, and especially with certain parts of the market, like you had housing prices are up significantly, even though that's starting to moderate more recently. I mean, used car vehicle prices were skyrocketing, and then you have, I'll let you talk, Jack, to the supply side issues, but we're seeing the highest inflation I think that we've seen basically since the late 70s in terms of this 8-9% annualized inflation. Now we are seeing certain things like commodity prices to some extent moderate here, especially in the metals, but it's still here front and center. And this is an inflationary environment that many investors, including me and you.
Yeah, I mean, this goes back to our days of UConn with, Economics 101 or whatever it was called. This is basically a supply and demand issue. With any situation, if you increase demand while supply is constricting, what's going to happen is price is going to go up. And so, like you said, we had all this fiscal stimulus. We had a bunch, probably too many fiscal stimulus packages. The effect took a while to get into the system, but people, demand for goods went up. And then on the supply side, COVID was obviously caused big issues with supply chains. The Ukraine crisis certainly made it worse. And so you've got the perfect recipe for high inflation. You've got high demand, reduced supply, you've got high inflation. And so that's kind of where we are now is, we're printing some of the highest CPI numbers we've seen since, other than people who were in the 70s managing money. For those of us that weren't doing that, I mean, this is the highest level of inflation we've seen in our career. And, we'll talk maybe about where that might go in the future. And obviously we don't know that. But the idea is that set the stage for very high inflation. And that's where we are right now.
See, some people think that the supply side, and this is where the Fed was, up until maybe a couple months ago, that a lot of the supply chain issues would, work themselves out. And I think you can sort of think that will occur. It's just what's changed in the world and what's changed in the market is the whole supply side strategy. Where are you sourcing your important or maybe even food and things like that from? I think the war in Ukraine and COVID sort of has opened up companies and consumers' eyes to, where are we getting this from? And, you could see, I don't know, you could just see the supply side of it not working its way through as quickly as some might have anticipated at the beginning.
Yeah, I mean, if you look at something like oil, that's a good example of it. We obviously have the ability to put a lot more oil supply online in the United States, but it's not like you just go up to these drills, and hit the on button and like suddenly oil starts gushing out of there. It takes time to do it. And so the supply chain issues will likely eventually work themselves out, but it's hard to figure out how long it'll take. And the other thing we didn't talk about earlier, but we should have, is this idea that, remember back in late last year, the Fed said, well, inflation is transitory. So is inflation really transitory? Were they wrong about that? And the answer is, they were, but they also weren't. Inflation certainly is transitory, but what matters is what period is it transitory over? So when the Fed said that, people kind of got the idea it's transitory over a short period of time. It's going to go up and it's going to come right back down. Obviously, looking at a 5-year period, inflation is likely transitory. We're not going to likely be seeing 8% inflation 5 years from now. But, that's sort of the idea of like the importance of words and the importance of, explaining what's going on, because it is transitory, but it's lasted a lot longer than they thought it was.
And by the way, the negative effects of inflation, obviously from a consumer standpoint, you're paying more for whatever it is, gas, food, energy, clothes, whatever it might be. So that's less savings. Your money only goes so far, especially if you're someone that has a fixed income. Think about retirees on pensions and stuff like that. And then from a company standpoint, obviously input costs are higher and wages are possibly higher. So if you think about that, that means less profits fall to the bottom line. So this is why inflation, as Warren Buffett says, swindles everyone, because, from the consumer standpoint, less money in your bank account, your money doesn't go as far. And from the corporate standpoint, it can hurt profits. And then we have to combat inflation, we have the Federal Reserve coming in and hiking interest rates. And higher interest rates means higher borrowing costs, and that has a whole series of effects on the market and sort of business and economies as those rates move higher.
Yeah, so getting into the Fed, obviously we've seen them increasing rates, and we've also seen them, before they ever increased rates, they use this idea of forward guidance, which is the idea that what Ben Hunt calls the Fed's words. And so the Fed, by effectively telling you they're going to do something, they can generate the effects of actually doing it in advance. And so that's kind of what we've had this year. Joe Weisenthal had a chart on Twitter recently. We'll see if we can maybe find it and put it in the video. But the idea was the pace at which financial conditions in the economy have tightened during this tightening cycle is the greatest of all time, or at least as far as data goes back. So the amount that has been tightened in a short period of time is very high relative to what's occurred in the past. And that might be justified because we're seeing very high rates of inflation, but it was just interesting to see how fast it's happened. And so how are they doing that? They're doing it through forward guidance, telling you what they're going to do. They're doing it through higher rates now. They're hiking at each meeting. And they're also doing it now through quantitative tightening. And so if you think about the idea before of quantitative easing, well, the Fed was buying bonds. Now what the Fed's going to do is they're going to reduce their holdings of bonds. But in order to understand that, I think it's important to kind of think about the different phases of quantitative tightening. So obviously quantitative easing, they're just buying bonds. But in tightening, there's different ways they can do that. So what they did at first before they started tightening is they said, all right, let's keep our balance sheet constant. And so keeping their balance sheet constant, it doesn't mean they do nothing. It means they have to continue to buy bonds. And the reason they have to continue to buy bonds is there's roll-off. So obviously some of the bonds in their portfolio are maturing on a regular basis, and they're just buying it back to keep their balance sheet constant. So now we've moved into quantitative tightening. And so what's happening right now is they're still buying bonds. And the reason they're still buying bonds is the amount of quantitative tightening they've decided to do is not equal to the roll-off. And so there's more bonds rolling off than they're gonna buy back. So, or than they want to roll off of their balance sheet. And so they're buying bonds right now, but their balance sheet is being reduced. And so there could be a next phase beyond this where you effectively just let all of it roll off. And so you're not buying any bonds. And then obviously longer term, there could be a final phase where they actually start selling bonds. But right now what they're doing is that they're letting a portion of that balance sheet run off. They're still buying some bonds. And so that is a tightening in addition to higher rates, in addition to they're continuing to use forward guidance to tell, the market, here's what we plan to do in the future. And what they're saying right now is that they're going to be doing, a bunch more tightening.
And this has a number of spillover effects that are affecting the stock market. And so let's sort of talk through those, because this is really, I think for a lot of people listening, this is pretty much like where we are right now with higher rates and this quantitative tightening happening. So the first thing that we're seeing this year is, well, a couple things. You're seeing relative outperformance of value versus growth stocks. Even though both cohorts of stocks are down, value is outperforming growth on a relative basis. And we'll talk about why that is in a minute. You're also seeing bonds down. So the 60-40, I believe, is having maybe one of its worst years ever, because you have losses. If you just take a standard 60-40 portfolio, let's say 60% S&P 500, which is down around 20% this year, and then 40% like an aggregate bond index, it might be down something like, maybe 10 or 15% this year. So, the 60-40 might be looking at something like a 15% loss year to date, which is, really painful for people in that type of investment allocation. But these higher rates have a number of different knock-on effects. And so let's talk through those. I mean, the first thing is, when we're talking about growth stocks, Jack, and the present value of those cash flows way out in the future, when you have higher rates, that obviously impacts the value of those cash flows significantly.
Yeah, I mean, it impacts all stocks, but it impacts growth stocks more. So the idea is basically if I have a series of cash flows in the future, I'm going to discount those cash flows in order to look at what they're worth to me today. I'm going to discount them back with some sort of interest rate. And as interest rates rise, that discount rate goes up. And so that should make, in theory at least, that should make all stocks worth less, because all stocks, there are no stocks that have all their cash flows in the present. All of them have some degree of future cash flows. They're all long duration assets, but growth stocks are the longest duration assets. And so those should be impacted the most. So in theory at least, what should be happening is what's happening. Rates are going up, growth stocks are coming down, value's performing better on a relative basis. What's interesting about that though is, if you look historically at the relationship between value versus growth and interest rates, that is not true. So growth stocks have not done worse historically during periods of high rates, and value stocks have not done better. And it's interesting, like a lot of people, AQRs looked at this, and there might be a slight relationship, but it's a weak relationship. But also you have this idea that we talked about with Ben Hunt of narrative. So if everyone believes that ultimately growth stocks are going to do worse during a period of high rates and believe the logic I just said, well, then that's what they're going to position their portfolios with. So they're going to go sell growth stocks. And so, this might be a largely narrative driven thing here. People are saying, this is what makes sense in this environment. That's the narrative. So I'm going to do it. So anyway, but that's essentially what's been happening in the equity markets. Equity markets are obviously down. Inflation is a significant risk, and higher rates are a significant risk for the equity market. It's down. And growth stocks have been underperforming substantially.
The other thing, like coming in, like we talked about earlier, growth stocks were so highly valued coming into this year. They would have had to deliver on, almost unrealistic expectations to like grow into those valuations. So to your point about the cash flows, maybe this is being, in this environment, the downturn in growth is being accentuated by this higher rate thing because of the mathematics. But maybe when you look at the regimes of value versus growth historically, you don't get the interest rate sort of narrative, if you will, that we just sort of talked about. It's not as strong, to your point about what some of this other research shows with value versus growth and interest rates. A couple other things that are happening. Obviously, you up until recently, you've had a massive uptick in commodities. What's interesting is commodities did terribly from 2005, 2006, all the way up until, mid to late 2020, and then they exploded higher. And you do tend to get these sort of massive moves in commodities one way or another. You sort of have these commodities super cycles, at least historically, that have happened, which kind of plays into some of the strategies that are all alternatives that use momentum and things like that can go into commodities. Those types of strategies actually have done better this year because they've had some commodity exposure.
Yeah, and this gets to the idea of, is the 60-40 portfolio enough, which we've talked about in other episodes. But, coming into this year, expected returns on bonds were terrible. Expected returns on stocks were terrible. You had the potential for inflation. You could have made a pretty strong argument that, you needed something in addition to your bonds and your stocks in the portfolio. And people who did add exposure to commodities have done very well this year, which you'd expect. Obviously, inflation is very high, so the prices of commodities are going to do very well. But to your point, commodities are not something typically you want to hold long-term in your portfolio because they go through these horrendous periods, where they do really poorly. And, if you're going to hold commodities, typically using some sort of trend following is a good idea. And, for people who have done that, they've been, capitalizing on this positive trend in commodities. And, these multi-asset type portfolios that go beyond stocks and bonds, the risk parity type things have done a lot better this year than a 60-40 portfolio.
One of the other things we're seeing, and I think it's in both public and private markets, but is a lot of investors, whether it's individual investors or investors in private companies like venture capitalists, want to see companies getting positive cash flow or trying to have a line of sight to positive cash flow as quickly as possible because, as liquidity sort of gets tighter and so some of these growth stocks, come in, that has sort of downstream effects all the way to all these private companies that have raised, significant venture capital money. But it's I think those VCs are basically saying, we're going to focus on our top tier companies, the one in our portfolio that have the best prospects, and everyone else, you better start thinking about, making your cash last as long as possible and, generating positive cash flow as quickly as possible.
Yeah, what's interesting to me, and, we sort of lived through the 2000 .com bubble, when we were a small company and, a small company that didn't make it, is this idea that I think the VCs and everybody is shifting a lot faster this time. So back then, it took a long time for people to kind of realize, all right, we can't go to this growth at any cost approach. We have to generate cash in these businesses. Right now, you've seen all the major VC firms out really, quickly with these things for their founders, essentially saying you have to focus on cash flow. You have to increase your runway. You have to make your money last. Even if you have to do that at the expense of growth, you have to do that or you're not going to make it. And so I don't know what that means yet, but I think that's an interesting difference. But getting back to your point about cash flows, when you have unlimited money available to you at effectively 0% rates, and you want to grow, what are you going to do? You're going to use that money, and you're going to use that money to grow your business. And so a lot of businesses that are very long duration businesses can do really well in that period. If you think about like SpaceX or something like that, something that's going to take a very long time to generate positive cash flow, those businesses can do very well because they just have access to capital after more capital. But what happens when you get into this inflationary environment is you're going to get into a situation where it's much more expensive to borrow this money or to get this money, or you can't get it at all. And when you get into that situation, cash flows become really important because it's how you fund your business. And so if if a company produces positive cash flow, then it doesn't have to go to other people to get cash to run its business. It can just use that cash flow to grow its business. And so, although a lot of us have sort of talked about fundamentals didn't really matter, in this past decade, fundamentals might matter a lot more here. And the reason is because companies that generate cash are the ones that are going to survive. They're the ones that are going to have money to grow. And so that's a huge difference when you get into these higher rate and inflationary environments.
Right. Getting back to sort of the market valuation here, we do have a tool on Validea. It's called the market valuation tool. And what we do is we look at the market through a bunch of different valuation metrics, and then you can have segments of the market. So for example, you can say, show me large cap value versus small cap value on, various valuation metrics, and compare and contrast different segments to see where there might be more value or less value. And so there's a lot of different ways to sort of slice and dice that tool and that data. But it is interesting, like when we look at the market's overall value, given where things have come down as much as they have, the market looks kind of cheap here using the way we do it based on, I think, like you were saying, the median stock.
Yeah, so there's two different ways to look at this. One is sort of the valuation of your market cap weighted indexes. And, we'll put this chart back up that we talked about at the beginning. The market's CAPE was 37 or so coming into this. Now it's 29. So it's not as expensive, but it's still very expensive. Historically, 29. I think the average over time is something like 17. And even the average in the past, few decades when valuations have been higher is still, something in the 20s. So we're still pretty high on the valuation of market cap weighted indexes. But then when you look at the median stock, what's happened is we went from the highest we've seen, since we've been tracking this in 2005 to effectively getting very close to the lowest we've seen. The only lower period now, we're kind of similar to where we were at the bottom of 2020, and 2008 was lower. But, if you look at just the median stock in our database, at least on, we're using the current year earnings estimate here, things have gotten a lot cheaper. Now there are some caveats to keep in mind with that. One is basically that this is on earnings. If we put this same chart up on sales, it's a different picture. It's much more expensive. And the reason is because margins are very high right now. The other thing is, if we are going into recession, a lot of people think earnings estimates have to come down. And if earnings estimates come down, then valuations are going to go up. So this is using what earnings estimates are today, June 29th, 2022. Obviously, if earnings estimates have to come down, the market's going to look more expensive. But it is interesting that, your average stock here, your median stock does look pretty inexpensive. And, there's a lot of different ways to look at it besides the way we have, and you'll see other charts on Twitter. But I think that is an interesting thing here, given the amount of the declines we've seen.
Yeah, and we also do the value versus growth. And even though value has outperformed growth handily this year, value still looks cheap relative to growth stocks, at least going back to 2005, which is what our data goes back to.
Yeah, we went from basically the first percentile to maybe the 12th percentile or so. So value isn't as cheap, but it's still extremely cheap. One of the other things that's changed this year is if you look at value on an absolute basis, so don't compare it to growth, just say, how cheap are value stocks in general. I mean, they're also, at basically all-time lows from when we've tracked this in 2005. So value stocks, both on an absolute and a relative basis, are still very, very cheap. They're relative, they're not as cheap as they were, but on an absolute, they're actually significantly cheaper because although they've outperformed this year, they have gone down. And they've gone down while earnings are still going up. So if you're a believer that, current earnings or current earnings estimates are at least somewhat of a reasonable predictor of what's going to happen in the future, then, your median stock looks pretty cheap and your median value stock looks very cheap.
Just as a side note, did you see that the Russell rebalanced their portfolios? And I think Facebook, there was a couple of these big tech names that got basically moved from the Value 1000 growth to the Value 1000 value index.
Yeah, I did see that. It was interesting. I mean, Facebook, you could maybe make a case, and they're using price to book as one of the primary things there, which is why it's happening. But some of them, it's hard to. I mean, I think Zoom is now in the value index. So some of them are kind of hard to justify. But yeah, you have seen some of the big tech names have become, a little bit more of a value play than they were.
And I think you nailed it. I mean, I think it really comes down to, and this is where we're going to get into sort of where we go from here. And anyone that has listened to Jack and I talk should probably know that we're not big on forecasts and predictions and trying to, game where the market's going to go in the next 12 months, because that's basically impossible to do. And anybody that can say that anybody that does it can't do it consistently. So, but I do think the $1 million question is, whether we go into a recession or not, because what history would tell you is if you get 20 to 30% decline and you actually have a shallow recession or no recession, then usually those would be buying opportunities. If we go into a recession and growth slows and corporate profits get hit, you could definitely see this bear market, being something like your more standard traditional bear market where stocks are down 35% plus.
Well, first of all, I'm disappointed that I'm not going to get Justin's 12-month market call here because, when we signed up to do this, I thought I was going to get it and I thought I was going to know whether I need to go all in or not. But yeah, thinking about it, obviously it's impossible to predict where the market's going to go from here. We just don't know. You do know that over the long term, for long-term investors, every correction, every bear market, they're always buying opportunities, but the buying opportunity doesn't always come right away. So if we're 20% down now, we might go down 40%. And so 10 years from now, you're still gonna probably do pretty well with that. But timing when this is going to end is very difficult. And one of the points I think it's really important to make here is where we go from here. Although we don't know, it's always a function of expectations versus reality. So the market's not going to necessarily tank because inflation is very, very high. The market's going to keep going down because inflation continues to exceed expectations. You have a certain level of inflation built into the market right now. And where we go in the future is going to very much be a function of what is the reality relative to those expectations. We have people on Twitter we follow who are exceptionally smart, who think that reality is going to be inflation is going to continue to exceed expectations, and that's going to be really bad for the market. We have other people who are really smart who think inflation has already peaked. We're headed into, at least a mild recession. Everything's going to start going down the other way. And, we're not smart enough to know, what's going to happen. But what we do know is that as the market declines for investors, future expected returns go up. As valuations go down, long-term future expected returns go up. And I think that's the only thing we can kind of have faith in as an investor is, as that market decline is happening, my future, although I'm losing money now, my future gets to look brighter. Now, whether your short-term future, what's going to happen there, we don't know. But the long-term future, the 7 to 10 year future looks brighter as the market continues to go down.
And as investors, we have a recency bias in us. So we're always more influenced about what is happening more recently in the here and now. And, I did write an article last week around things that could go right in the market. But then I sort of ended the article by saying, even if none of those, and this is to your point, even if none of those materialize, if investor expectations are like in a worst case scenario and these things come in a little bit better, the market still could react sort of positively. And, I sort of started that article with the AAII and sentiment poll, which shows that a very, very high amount of bearishness right now for all the things that we've kind of talked about and highlighted here. But as investors, as a group, our emotions tend to get the best of us in certain times. And so that's important to remember and think about when you're sort of in the midst of a bear market or you're thinking about corrections or bear markets and where the market might go.
Yeah, and that idea of sentiment, that shows kind of how hard this is. So, for most of this year, sentiment has been horrible. I think is it Bank of America that does that fear and greed index? I don't know who does it, but it basically is maximum fear. It is the most it could possibly be in the direction of fear. And, typically as investors, what we're taught is, take the opposite side of that. If sentiment is really terrible and everybody's fearing, we want to be greedy. But the problem is throughout this year, that's continued to be the case and the markets continue to go down. So, it's really, I think the biggest lesson here is it's really hard. And, unless you're a really expert investor who has, great information, it's very, very hard to try to time any of this. And, for your average investor, it's great to understand this. It's good to understand what's going on. But, there's not really much you can do in terms of figuring out like what expectations are embedded in the market and, what's my economic forecast and how's that going to be different than expectations. I'm just not smart enough to do that. And I think most people aren't either. So, I don't know what else you can do besides have a long-term strategy that you believe in and that you can stick with. And that doesn't have to be a 100% equity strategy. It can be a strategy that's multi-asset class. It can be a lot of things, but I don't know what you can do in periods like this other than have your long-term strategy and stick with it and just try to ride these things out.
Yep, I agree. I think that's what investors should be doing, and taking a long-term view is the most important one. So hopefully this has been helpful in terms of understanding how we got here, where we are today, and even though you didn't get my 12-month market prediction, hopefully we ended it on a good positive note. So thank you guys for watching, and we'll see you next time.
Thank you.
Hi guys, this is Justin again. Thanks so much for tuning into this episode of Excess Returns. You can follow Jack on Twitter at @PracticalQuant and follow me on Twitter at JJ Carbonneau. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.